Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hey everybody, today is January 12, 2026. This is your host, Brent Foster. Let's dive in. So all three major averages rise. Stocks posted solid gains in an action-packed week last week of market-moving economic data, geopolitical news, and bullish New Year's sentiment. The S&P 500 index rose 1.6% this week to a fresh closing high and a broad climb led by consumer discretionary sector. The S&P 500 ended Friday's session at 6,966.28, its highest closing level ever. The market benchmark also reached an intraday record on Friday at 6,978.36. The NASDAQ Composite Index added 1.88%. The NASDAQ Composite set a new record closing high last week on Friday, January 9, 2026, closing at 23,671.35, surpassing previous records from late 2025 and early 2026, with the tech-heavy index pushing past 23,000 and hitting fresh intraday highs during the week. The Dow Jones Industrial Average rose 2.32% last week. The Dow Jones Industrial Average hit a record closing high of 49,504.07 on Friday, January 9, 2026, capping a strong week where all major indices reached new highs, buoyed by positive employment data that suggested stable economic growth. The MSCI EAFE index, which tracks developed overseas stock markets, advanced 1.41%. So the Dow, the S&P, the NASDAQ, they're building. All three major averages continued their rise through midweek as the AI trade led by chip manufacturers helped momentum. Shares of home builders and other companies connected with the housing market were among the S&P 500's top weekly gainers after U.S. President Donald Trump said he was instructing his representatives to buy $200 billion in mortgages or mortgage bonds. Quote, "This will drive down mortgage rates, monthly payments down, and make the cost of owning a home more affordable," end quote, Trump said in a social media post. Economic data came in mixed as December non-farm payrolls in the U.S. rose by 50,000, missing the 70,000 increase expected according to a survey compiled by Bloomberg. The unemployment rate, however, decreased to 4.4% in December from a downwardly revised 4.5% the month before. A 4.5% rate had been expected. U.S. consumer sentiment improved in January to its highest point since September, but remained subdued compared with year-earlier levels amid inflation and labor market concerns, according to preliminary results from a University of Michigan survey. The consumer discretionary sector had the largest percentage increase for the week, climbing 5.8%, followed by a 4.8% rise in materials and a 2.5% advance in industrials. Communication services, energy, and consumer staples also rose more than 2% each. Home builders Lennar and Pulte Group were among the top gainers in the consumer discretionary sector, rising 14% and 11% respectively amid Trump's plan for his, quote, representatives to buy $200 billion in mortgage bonds. The plan also gave a boost to shares of builders of First Source, which was the top performer in industrials, jumping 19% on the week. Albemarle had the largest percentage gain in materials, climbing 13% amid several positive analyst actions on the stock. Among them, Baird upgraded its investment rating on Albemarle's shares to outperform from neutral, while raising its price target on the stock to $210 per share from $113 per share. Analysts at Jefferies, Berenberg, and BofA Securities also raised their price targets on Albemarle's shares. Utilities was the lone decliner for the week, dropping 1.6%. NRG Energy was the hardest hit stock in utilities, falling 10% on the week as the company unveiled a new CEO succession plan. Robert Gaudette was named the NRG Energy's president effective immediately and chief executive effective till April 30th. Gaudette, who manages the company's wholesale operations and power generation, will succeed Lawrence Coben. Lawrence Coben, who will remain as chair and CEO until April 30th and will serve as an advisor for the remainder of the year. The earnings season kicks off this week on Tuesday with reports expected from companies including JP Morgan Chase, Bank of America, Wells Fargo, Citigroup, Morgan Stanley, and Goldman Sachs. All right, Y charts, weekly market insights, the trailing number I like to look at, the year to date. Dow Jones Industrial Average is up 2.54% for the year so far. S&P 500 1.14%, Nasdaq 1.03%, MSCI EFA is up 1.47%. The 10-year Treasury note trading right around that 4.18 level, just kind of sitting there for now. We'll see where it ends up going. Kind of just flat on the 1 month change. So not much movement there over the past 30, 45 days. Jobs report. The labor market's latest employment report again showed a net gain of 50,000 jobs last month. And, they missed the economic expectations of around 73,000 jobs. So over the full year, net job growth averaged around 49,000 per month, the lowest monthly pace in 22 years, and a drop from 168,000 per month in 2024. Federal job cuts were a primary reason for the sluggish labor market in 2025, with 277,000 government positions eliminated. Again, key economic data, we've got a lot of Fed heads talking. So Richmond Fed, Atlanta Fed, New York Fed, those guys are going to speak. Tuesday, the NFIB Small Business Optimism Index, Consumer Price Index, new home sales for October. Then we got the St. Louis Fed guy speaking, Richmond Fed guy speaking, and then the federal budget deficit, which will be an interesting data number to look at. Wednesday, retail sales for November, Producer Price Index, the PPI for November, business inventories October, existing home sales, Federal Reserve Beige Book, Fed President's Neil Kashkari, which is the Minneapolis Fed, Boston and Atlanta, and then again, New York. They're all speaking Wednesday. Thursday, looks like weekly jobless claims import prices for November. Kansas City Fed, Richmond's Fed speaks again, industrial production. Oh, man, just like Fed heavy. And what's interesting is this morning, DOJ the Department of Justice issued subpoenas for Jerome Powell. And in light of some sort of overextension of overbuilding or overspending on this remodeling project for the Federal Reserve in New York. So it'll be interesting to see what's going on there from a political standpoint. It seems like Jerome Powell's talking about how it's politically motivated because Donald Trump wants to lower interest rates and he's not willing to do it. And I think this is a sideshow drama. We'll see what happens. That's about it. We've got the banks kicking off earnings starting tomorrow, Tuesday. All right, tax tip of the week. Tax benefit and credits, FAQs. So frequently asked questions for retirees. Many questions can arise about income taxes after retirement. Listed are answers to just a few common questions from retired taxpayers. So here's a question. What types of income are taxable? So some common types of taxable income include all or part of a pension and retirement account income, gambling income, alimony, or prizes. Okay. What types of income are non-taxable? A few examples of non-taxable income includes veterans benefits, disability pay for specific military or government-related incidents, workers' compensation, and cash rebates from a dealer or manufacturer of an item that you have purchased. Why is my pension taxed? That's another common question. It may depend on how the money was put into the pension. For example, if the money was not taxed before going into the plan, it may be taxable. Conversely, if your contribution is from already taxed dollars, that portion of the pension may not be taxed. This information is not a substitute for individualized tax advice. Please consult your qualified tax professional to discuss your specific tax issues. And this tip was adapted from irs.gov. All right. Practicing gratitude. This is an additional piece on just behavior. And psychologists have defined gratitude as a positive emotional response, receiving a benefit from someone or something. And positive psychology, gratitude is the human way of acknowledging the good things in life. Thankfully, you can learn gratitude if it does not come innately. All right. So practicing gratitude offers numerous benefits, particularly during times of stress and uncertainty. Gratitude invites positive emotions that can have a physical benefit through the immune or endocrine systems. Research shows that when we reflect on what we appreciate, parasympathetic or calming part of the nervous system is triggered, which can have protective benefits for the body, including decreasing levels of the stress hormone cortisol and increasing oxytocin, the hormone involved in relationships that fosters feelings of well-being. There are a few great ways to get started today and practice gratitude in your own life. 1, write thank you notes. 2, keep a gratitude journal. 3, follow up with your family and friends. 4, give back to your family, friends, and community. And 5, pay kindness forward. Just having a kind attitude, right? Tip adapted from mindful.org. So if you want to check out more tips like that, go to mindful.org. All right, stay tuned for the next segment. All right, this article is really interesting. It is written by Meredith McGraw at the Wall Street Journal, and I wanted to go over it because it came out today. Trump calls for 10% cap on credit card interest rates. Previous proposals to cap interest rates haven't gained much traction in Congress. This is updated January 9th, and today is the 12th, actually, so I misspoke on that one. But President Trump called for credit card interest rates to be capped at 10% for 1 year in his latest attempt to address voter concern about the stubbornly high cost of living. Please be informed that we will no longer let the American people be ripped off by credit card companies that are charging interest rates of 20 to 30% and even more, the president posted Friday on social media, adding that he wants the cap to begin on January 20th. Trump proposed a 10% cap during the 2024 presidential campaign as a way to ease the burden on Americans who are carrying high levels of credit card debt. It is one of several affordability-focused proposals he has floated in recent days. On Wednesday, Trump announced a ban on institutional investors from buying single-family homes. On Thursday, he suggested that the mortgage companies Fannie Mae and Freddie Mac could buy $200 billion in mortgage bonds to help lower borrowing costs. The president is expected to lay out his affordability agenda and housing policy during a speech at the World Economic Forum's annual meeting in Davos, Switzerland, later this month. Credit card rates average around 23%, according to the Federal Reserve. The average credit card interest rate hasn't fallen below 10% in Fed data going back to 1994. Borrowers in lower and middle income households who carry balances would benefit the most from caps on credit card charges. They would also be the first ones banks would stop lending to if the caps were enacted. So, according to experts, and banks might impose fees to make up for lost revenue. The American Bankers Association and other industry groups said in a joint statement that Trump's proposal would hurt millions of American families and small business owners. If enacted, this cap would only drive consumers towards less regulated, more costly alternatives. We look forward to working with the administration to ensure Americans have access to the credit they need, end quote. Bipartisan legislation for a cap on credit card interest rates was introduced in the House and Senate last year. Senator Bernie Sanders, independent of Vermont, has said he supports Trump's plan to cap credit cards and credit card rates at 10%. Hours before Trump's announcement, Sanders, in a social media post, said Trump promised to cap credit card interest rates at 10% and stop Wall Street from getting away with murder. Instead, he deregulated big banks, charging up to 30% interest on credit cards. Senator Elizabeth Warren, Democrat of Massachusetts, said in a statement, I said earlier, quote, I said a year ago, if Trump was serious, I'd work to pass a bill to cap rates. Since then, he's done nothing but try to shut down the Consumer Financial Protection Bureau, or CFPB. The Biden administration attempted to push through an $8 cap on credit card late fees, but a federal judge in Texas halted it from taking effect. So there's near 637 comments already to this article. It is definitely going to pick up steam as subject matter that's in focus here as a common problem for a lot of people out there with credit cards. And so, updated just an hour ago was another article: what 10% credit card rate cap would mean for your wallet. Here's another Wall Street Journal piece that goes on to talk about it a little bit more in depth. And Veronica Dagher of the Wall Street Journal writes this particular piece. In a move aimed at easing economic pressures on American households, that 10% temporary cap on credit card interest rates. Trump didn't offer any details, but it would begin on January 20th. Well, that's pretty crazy in 8 days. They're moving quick. As people with lower credit scores can pay rates up to 36%, according to Bankrate. The average store credit card charges more than 30% in interest rates on carried balances, of course. Interest rates at federal credit unions are already capped at 18% by law. Elevated delinquencies and charge-offs are among the reasons for today's higher credit card rates, said Ted Rossman, a senior credit card analyst at Bankrate. That is because credit card debt is unsecured, meaning there's no collateral to back it. With an auto loan, by comparison, a lender could seize the car after missed payments. About 2.98% of credit card balances are currently delinquent, according to the Federal Reserve. That is up from just under 2% in parts of 2021 and 2022, when late payments were suppressed in part by pandemic-era stimulus and forbearance programs. The figure has leveled off recently. How could this proposed rate cap help consumers? Well, a 10% cap would save American households roughly $100 billion a year in interest payments. According to recent analysis out of Vanderbilt University, that could translate into meaningful savings on an individual level. A person with a $5,000 balance at 24% interest, for instance, pays about $100 a month in just interest. At 10%, the interest payment would drop to about $41 a month. That would let the borrower pay off the principal balance much faster and add up to around $700 in savings over a year on interest alone. Trump didn't say whether his cap would apply to new or existing balances. Other rate cap proposals have focused more on new balances. So, what could end up hurting consumers? The credit card industry warns that many people, especially those with lower incomes and lower credit scores, could lose access to credit cards. One industry estimate based on prior proposal said close to 90% of cardholders could lose access to credit either through account closures or reduced credit lines. If enacted, this cap would only drive consumers towards less regulated, more costly alternatives, the American Bankers Association and other industry groups said in a joint statement. So, if the cap were to apply only to future purchases, Rossman suspects card issuers might stop letting many people with lower incomes and credit scores make new purchases. Existing balances could be frozen and people would have to pay them back over time under the old terms, he said. Consumers might gravitate to alternatives that can also have staggeringly high interest rates. Buy now, pay later firms offer shorter term loans that are often interest free, but longer term BNPL, buy now, pay later loans can carry annual percentage rates approaching 36%. How could credit card rewards be affected? Well, credit card lending would become a lot less profitable and issuers would likely make their rewards programs a lot less generous. The same Vanderbilt study predicts $27 billion hit to rewards programs for people with FICO scores under 760. Card issuers could also introduce new annual fees or increasing existing ones. Which companies would be most affected by this? Card issuers that typically serve a wider spectrum of credit profiles, such as Capital One Financial, which is down actually 6.76% today. Synchrony Financial is down 8.21% today on the news, are among those most at risk. Their stock prices usually drop when such proposals gain traction, and we're down around 10% in the pre-market trading on Monday, which is today. Shares of other credit card issuers, including JP Morgan Chase, Citigroup, Citigroup's down 3.56% today. And American Express, down 4.42% today, also fell. So it isn't clear how Trump would enforce a cap. Most legal experts say that the president can't just unilaterally cap interest rates by executive order, and that such a cap would require an act of Congress. Senator Roger Marshall of Kansas said in a social media post that we will be leading this legislation to lower costs for American families. Bipartisan legislation for a temporary cap on credit card interest rates was introduced in the House and Senate last year, again with Bernie Sanders and Elizabeth Warren among its supporters. So it'll be interesting to see. The CFPB, a federal watchdog for consumer financial products, attempted to push through an $8 cap on credit card late fees. But again, the federal judge halted that from taking place. So it's going to be interesting to see how this makes its way through the court system. All right, moving on to the final segment. Jason Zweig, he writes this article, When Your Private Fund Turns $1 into 60 cents. And he's a writer for the Wall Street Journal. I respect him and a lot of what he says, and he brings this to light. And for all fund investors, he says, NAV, net asset value, is supposed to stand for net asset value. For some, however, it's turning out to mean not actual value. Okay? That's a joke, not actual value. That's the hard lesson of recent weeks when some funds that invest in private assets have sought to become publicly traded. Prices that investors expected to be stable have collapsed as soon as the portfolios were exposed to public markets. So these transitions from private to public cast doubt on Wall Street's narrative that investors can have their cake and eat it too. You can have the mild price fluctuations of non-traded assets, or you can have access to your money whenever you want, but it's turning out that you can't have both. And this situation bolsters arguments that asset values in private market funds don't always reflect reality. And I would agree with that 100%. They often stay private a lot longer, or maybe you don't have access to your money when you want it. You want that money now, you're retiring, and then they say, nope, sorry. You might get it in a year, 2, 5, 10, or maybe not at all. And then what you're left with is an illiquid position within potentially an employer-sponsored plan, which would be terrible. We'll keep going. So on and around December 16th of this past year, what used to be a non-traded portfolio called Blue Rock Total Income Plus Real Estate Fund began trading on the New York Stock Exchange as Blue Rock Private Real Estate Fund, ticker symbol BPRE. With a stated net asset value of $24.36 a share, the fund closed at a market price of $14.70, a 39.7% discount from NAV. So when it went public, it actually was down like 40% right away. For every dollar the fund manager said your shares were worth at 9:30 a.m., the stock market was willing to pay you only 60 cents by 4 p.m. And the reason why I'm touching on this article is because that happens quite a bit. And the public doesn't fully understand what's going on there, I don't think. So on November 13th, another non-traded investment, FS Specialty Lending Fund, or ticker FSSL, listed on the New York Stock Exchange at a net asset value of $18.67 and closed the day at $14, a 25% discount from NAV. Meanwhile, other private portfolios seeking to list publicly have gotten stymied. Any asset is only worth what you can get someone else to pay you for it, okay? So that's why these recent deals are such a shock to the system. All these funds started out as non-traded entities, meaning that investors could only sell at specific times, as with Blue Rock or Priority Income, or investors could sell only limited amounts until the managers created a future, quote, liquidity event, as with FS Specialty Lending and Blue Owl Capital 2. That meant you could lock your money up for the long run in such potentially high-yielding assets as commercial real estate or private lending, sheltered from the upsetting fluctuations of public financial markets. My caveat there is, yes, that's true, and there's just more transparency in the public markets as well. The private markets, they don't have to share as much with you. So the managers could put your money into investments that sometimes takes years to pay off, he goes on talking about. They could crank up the returns with borrowed money without having to worry about that you would want to pull your money out during a downturn, and that they could earn an annual management fee of 1.5% or more per year. Often performance was strong, although some private markets began seizing up in 2022 and 2023. Then certain funds struggled to meet even the limited demand for periodic liquidity that they had promised to investors. Ramin Kamfar, chief executive of BlueRock, says he isn't surprised that its private real estate fund has begun trading so far below what his firm states the shares are worth. After its earlier respectable performance flagged in the past 3 years, more investors have been asking to cash out than the fund's previous structure could accommodate. Now they're lined up to sell, so there's a, quote, temporary supply and demand imbalance, end quote, Kamfar says. I find that actually pretty funny because maybe not for people invested, but it's just interesting that the structure is that way. And then that is a nice, gentle way to say, there's no market, everybody's selling and getting out while trying to get out the door before everybody else. So it creates a bottleneck, and that'll take a long time to work itself out. So before BlueRock, investors could cash out no less than 5%, but no more than 20% of their holdings per calendar quarter. Now they can dump their entire position in a single trade with an important difference. Before, investors could do these partial shares quarterly at net asset value. Now they can sell out completely anytime, but at the price someone else is willing to pay. And other people aren't willing to pay anywhere near what BlueRock Private Real Estate or FS Specialty Lending says that their assets are worth. FS says it's, quote, fully confident in the fund's potential to create lasting value, end quote. Kamfar says the BlueRock's fund's market price should converge towards net asset value over time. That's not a sure thing, though. And Zweig goes on to say, to be fair, most funds or their close relatives, business development companies, so BDCs, that are newly listed on stock exchange tend to trade at less than net asset value. And that's partly because of the costs and risks that come with portfolios of unusual assets that are sometimes leveraged with borrowed money. But it's hard to overlook the irony here. For years, the managers of many of these funds have been marketing them as a way to escape the volatility of public markets. And now they're just throwing them into the stock exchange, says John Cox, CEO of Cox Capital Partners, an investment firm in Philadelphia that offers to buy illiquid portfolios. Funny, probably at a discount. And he's not wrong. He's literally, John Cox is pointing it out. He's like, now they're looking for a buyer for these illiquid, depreciated assets that they're trying to get rid of. So it's interesting, leaving the public to buy them, which is not smart and not good for the public. FS Specialty Lending, Blue Owl Capital 2, and Priority Income had previously told investors that they could list publicly someday. More transitions like this are inevitable, says Leela Kunimoto, an individual investor who blogs about private funds at accreditedinsight.com. That's because as soon as returns falter at such private funds, investors start demanding their money back at NAV. That can rapidly shrink the funds and their managers' fees, so some managers take them public in self-defense. Most of all, these switches from private to public highlight a deeper risk. As Kunimoto says, private fund valuations are often, quote, a figment of imagination, end quote. The fund managers say their valuations of private assets are accurate and fair. When these funds hit the markets, though, investors are getting a shocking lesson in how subjective valuations can be. And if you want to ask more, write to Jason Zweig at Wall Street Journal, Intelligent Investor at wallstreetjournal.com. I've actually experienced this in the past, and it is not fun when this happens. And that's why I don't do them anymore. I don't look at them anymore. It's the public markets are doing quite well as a comparison to some of the private markets, and unless you have an exorbitant amount of money and resources and a whole team of legal professionals, accounting professionals, due diligence professionals, finance people, real estate people at your disposal to lean on and leverage, meaning control, and then having influence in deals and having control in situations, it just doesn't make sense for a lot of people. And that's my opinion. But anyway, I could be wrong. And I'm probably wrong in certain other instances, but I'm leery of this particular type of investment approach. I think that it's worth talking about, and I'll try to bring up more of this as we go. When you have the SP 500 returning around an annualized return of, 10% a year over the last decade or two, try to beat that. And you get transparency to understand what's actually in it, and you're buying the economy and saving and investing over time. So anyway, have a great rest of your week. Happy January 12th. And we'll circle back next week with some more of the Northbound Wealth Podcast. Here's to try to serve you, provide content and information that is helpful to your financial wellness in January, which is Financial Wellness Month. Take care. Talk to you soon. Thanks.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.